Hello.
Hi, Professor. How are you?
All right. Okay. So I will see. I have to open up the files. So tonight we're going to be looking at the Black-Scholes model and also the binomial option pricing model. So we'll be doing a lot of Excel tonight. So let me go into Brightspace and get those files open. Um, Hold on. Now here's the strangest thing. On the setup that I have here, I have McAfee as my virus checker, and it's a very aggressive program. So um, what I actually have to do is, yeah, I actually have to turn off one of these features in order for me to get it into NYU's website. So it's very frustrating, but it has to be done. So now I can get in. All right, here we go. Here we go. So this is the week 6, and we're going to be looking at models for pricing options. And I think I mentioned it multiple times that option pricing is a very challenging activity. And it took many, many years before a model was developed that could be used to price at least European call options. And that proved to be a major, major breakthrough. But since then, there's been a lot of progress in calculating prices for other types of options. So we'll be introducing the first and most important of all option pricing models, which is called the Black-Scholes model. Now, um, we're going to have some spreadsheets here. Let me just quickly download them. These are meant to be used as templates for the assignments because there's an awful lot of math here. So luckily, we can reduce it to several key functions and enable us to actually come up with the prices without too much difficulty. So a lot of the calculations are here already. So that's kind of without that we would spend weeks getting this stuff done. All right, so let me get everything open now. All right, well, it looks like it hasn't downloaded anything that I asked for. Isn't that nice? So I'll just go into my own. Well, wait a minute. Here we go. Here we go. So here are the slides, and then the two templates for Black-Scholes. And then later on, when we're ready for it, we'll open up the file for the binomial option pricing model. So you can see there's a lot going on here. All right, well, it's taking its sweet time. We'll give it a minute to wake up. Here we are. Okay, great. All right, so section 6 is, of course, pricing options. Save this real fast. All right, so what are we doing tonight? So we'll start by introducing the Black-Scholes model, and then we're going to see how it can be extended to price a large number of different kinds of options. And then when that's done, although we've already introduced this last week, we're going to revisit the Pocoll parity condition. And then finally, we're going to see how American options are priced with the binomial option pricing model. So We'll start by introducing, I think I may have already talked about this before. The Black-Scholes model was actually published in 1973 in a journal called the the Journal of Political Economy. That's what it is. After being rejected by 8 other journals, it finally appeared in print in the Journal of Political Economy in 1973. And this is one of those papers. It's kind of like Einstein's famous papers in the beginning of the 20th century that eventually won him the Nobel Prize in Physics. Well, these gentlemen also won the Nobel Prize, but in economics. Okay. And so the 3 researchers were Fisher Black, Myron Scholes, and Robert Merton. Merton actually joined the team after they'd already started working on this. And he actually gave them a lot of good ideas about the underlying mathematics behind what they were doing. He actually pointed them in a better direction, the direction they were heading. It would have been very difficult to extend their model to price other types of options besides simple equity options. And so Merton's ideas made it possible to extend the model into much more complicated directions. So in a lot of textbooks, including the Hull book, on which these notes are based, they do actually refer to it as the Black-Scholes-Merton model, because realistically it is the product of all 3 of them. Now, in 1995, or 7 rather, by that time, Fisher Black had already died, but Scholes and Merton were awarded the Nobel Prize in economics because this model proved to be so important to finance. So the original idea here was that this model was able to produce prices for European call options on stocks that did not provide any dividends. Okay, so it was very restrictive, but it was path-breaking in the way that it approached the pricing of options. So later on, it was extended with put call parity to price European call options, European puts rather, with no dividends. But then after this, all these papers were published, Merton later on showed how we could use this model to price options on other types of assets, even those that have some kind of cash flow. So first, let's take a look at the original Black-Scholes model. Now, like a lot of models, it's based on a lot of very strong assumptions. And some of them are more of a problem than others. In other words, there's varying degrees of realism here. And the thing about models is that ultimately what matters is not so much how realistic their assumptions are, but how good a job they do producing results. Okay. In fact, there's a very great quote. There's a very famous economist named Milton Friedman, who was a Nobel Prize winner himself, and he said something to the effect that the value of a model depends not on the realism of its assumptions, but on the accuracy of its predictions. So let me see if I can find the exact quote here. Not, it's okay. I just wanted you to know about this. There it is. The role of theory is to provide a framework for explanation and prediction. Theory is not validated by the realism of its assumptions, but its ability to generate predictions that are not refuted by the facts. So he was talking about economic models in general, not the Black-Scholes model, but that certainly applies here because the Black-Scholes model has a lot of assumptions that are not necessarily accurate, but it makes it possible to come up with results that are very close to market prices. And the model itself is, although it's a very complicated model, it's easy to use it. And that's a huge deal. Now, keep in mind, in 1973, the technology was a little different than it is now. Even something as simple as handheld calculators were just starting to appear. And so the ability to have a relatively simple model that would enable us to grind out prices was a huge deal. It's not like today where, hedge funds are using computers that, had previously belonged to the Pentagon to make hedging strategies. I mean, this is a time when technology was very, very primitive. So a model like this was really a huge deal. So anyway, so what are some of these assumptions? Now, first of all, they're assuming that whatever is underlying the option And so in the case of the original Black-Scholes model, that would be the returns to the stock that we're trying to price an option written on, follow the normal distribution. Now, if you don't have a whole lot of statistics background, the normal distribution is a distribution that is heavily used in applied work. It appears in a lot of different applications, and it's something that does work very well for many, many applications, even if it's not completely realistic in every case. And you may have seen it illustrated with what's called a bell-shaped curve. So imagine that you have a stock whose returns are assumed to follow the normal distribution. So the normal distribution is characterized by two values. We'll make it a little neater. That would be the mean, which is often designated with a Greek letter mu. And that, let's say the average return to your stock is 5% per year. That would be in the center of your distribution. And then the standard deviation which is usually designated by the Greek letter sigma. Let's say in this case, it's 20%. So that means that determines how spread out the curve is, the size of the standard deviation. If the standard deviation is very large, then the curve is very wide and spread out quite a distance from the center. If the standard deviation is small, then it's the other way around. So let me show you a couple of examples of this. Let's say we have two different stocks and they have the same mean. This will be our first stock. And let's say the standard deviation is 20%, right? Just like the one we just saw. And that, let's say that would be your stock X. Then we have stock Y. And what's happening here is that the mean is the same. But it's quite a bit more spread out. As you can see, this would be, let's say, stock Y, same mean of 5%, but now the standard deviation is, let's say, 0.05. So the black one is stock X, and its mean is 5% per year, but its standard deviation is 20%. And then stock Y has a mean of 5, but its standard deviation is only 0.05. So that means the difference between the two is that with stock Y, there is a much higher probability of the actual return being close to 5%. Okay, so in other words, red means that the returns are very closely packed around the center. And so most of the time, the mean will be quite close to 5%, whereas with the black one, stock Y, X rather, there's a much higher chance of being quite a bit further away from that 5% in the middle. So that implies, the bottom line of all this is that stock X is riskier than stock Y. Because it's more spread out. Okay, in other words, we often use the standard deviation as a measure of risk. Okay, that standard deviation, the higher it is, the riskier the stock is. The mean is the center of the distribution, but the standard deviation is the spread about the center. And so the larger the spread, the riskier the stock is. Okay, so, but there's a lot more than that to the normal distribution. In particular, let me show you one of its important properties, and that would be something like this. Let me show you another curve. This will be the same one. Let's say this is still stock. Oh yes, please go ahead.
I think I got it right as soon as I raised my hand. I got the answer to my question. My question was about that spread, but I think I got it now.
Yes. Okay, yes, you see how the red curve is more tightly packed around the center?
Yeah.
And that means
So
that
it's more risky when it's spread out.
that's right,
Like,
exactly, because there's a much higher chance. So see, this can work in your favor or against you, because that means that stock X can have some really amazing years, but can also have some really awful years, where stock Y is much more steady and predictable from one year to the next. So let's say if you're retired, you'd probably buy stock Y instead of stock X. Okay.
okay.
So anyway, but another key feature here is that we have this wonderful property of symmetry. So in other words, the chances for this stock, and the diagram isn't perfect, I'll admit that, but the idea here is that because here we are 20% above the mean, and down here we're 20% below the mean. Those two probabilities are equal to each other. Okay. So the property that is responsible for this is called symmetry, meaning that there's a balance from the left to the right. So whatever's happening on the right side of the mean is exactly matched by what's happening on the left side. So those two have a probability. Actually, hold on, I can tell you the exact probability. Okay, they're each approximately 8% of being either at 20% or above, or as, let's say from 25% and up, or below minus 15%. And so in other words, there's a balance between the left-hand side and the right-hand side. That is a key characteristic of the normal distribution. And it's actually very helpful in a lot of applied areas, having this property. It certainly simplifies the calculations of probabilities. Now, the only unfortunate thing, though, is that stock returns are typically pretty close to being normal, but not exactly. Okay, they are a little bit off in the sense that with actual rates of return, there's an imbalance in favor of low returns versus high returns. In other words, in practice, you're more likely to see smaller negative returns than positive returns. So the returns are not exactly balanced the way they should be with the normal distribution. So we know this. So the assumption isn't perfect, but it's a very good assumption. It's very strong. The returns deviate to a certain degree from that, but not enough that we really can justify replacing this with another distribution. So in other words, what this is basically telling us is that in English, you're more likely to have extreme outcomes with actual stocks than are suggested by the normal distribution. And that means stocks are actually riskier than we are assuming in the Black-Scholes model. And in addition to that, there's somewhat of an imbalance in favor of the low returns versus the high returns. So the two sides are not equally balanced, not exactly. But having said that, it's still a very strong assumption. I mean, it's not crazy or anything. It's just not perfect. So that is one of the assumptions. Now, the other assumptions that it makes are also off, or there's one assumption that's less of a problem and another one that's more of a problem. So all of this was the first assumption, the normality of the returns to the stocks that we are pricing options on. Now, I do want to mention here as a side note, the standard deviation of a stock's returns, as we saw in those graphs, is often referred to in the financial markets as the stock's volatility. You'll often see that word used. When you hear the word volatility, they're talking about the size of those standard deviations to those returns. Okay, so volatility is a measure of risk. Higher volatility clearly means more risk. Okay. Now, the Black-Scholes model assumes that a stock's volatility remains constant during the lifetime of an option. Now, this, as it turns out, this is actually not necessarily true. The volatilities can change. So this really ultimately is probably the worst assumption of the Black-Scholes model, this assumption of constant volatilities, because we know that they can change fairly quickly. And options often have lifetimes of, let's say, several months, although they don't normally go past a year. In 3, 6, or 6 months, a lot can happen in the financial markets. And so volatilities can change. So that also can cause inaccuracies in the Black-Scholes model. Now, tons of research, by the way, is constantly being done to address these issues and find other ways of getting around them. And so what researchers will do is they'll take the Black-Scholes model and add other features to it to try to make it a little bit more realistic and less dependent on these assumptions. All right, so this word volatility will show up quite often in the next couple of weeks. So it is itself just another word for the standard deviation of the returns to these stocks underlying the options that we're pricing. The other assumption that is not such a big problem is the idea that the risk-free rate of interest, which basically refers to the yield on a treasury bill, is constant during the lifetime of an option. Now, interest rates do not change very rapidly. And so this is not a terrible assumption. So if, for example, we have a 3-month option that we're pricing, this risk-free rate would refer to the yield on a 3-month treasury bill. And while interest rates can change over time, they tend to change very slowly compared to, let's say, volatilities. So this assumption is not terrible. It's not terrible at all. In other words, it's a fairly safe assumption. But so the first two are not totally realistic. The second one in particular. The third one is not something we really worry about too much. Well, anyway, with all that being said, we'd like to know, what is this model? Now, when you first see it, you're going to say, well, that looks like a nightmare. And so what we have to do is first introduce all the variables and then try to make sense out of it. So these, by the way, these are all included in our templates here. So the templates have everything already laid out so we can see exactly how these options are being priced. But the actual formula for the Black-Scholes model is this. Oh, now that looks scary. Now, the C is the price of a European call option. The S is the asset, in this case, the stock that we're that we're pricing the option on. The X is the strike price of the option. R is the so-called risk-free rate. Again, it's the yield on a treasury security whose maturity equals the option itself. And then T is the maturity in years. In other words, if it's a 3-month option, this would be a quarter of a year. So I'm saving for last these two. These require a separate discussion. Okay, but the S, the C, the S, the X, oh, and E, we've run into this before. E is a constant that's approximately equal to 2.71828.
For my note purposes, can I get that what the N and the D are for, just so I can jot it down real quick? Or you don't have
Oh,
to
they're
worry.
coming up next. Oh, don't
Oh,
worry,
they
they're
are.
coming up.
Okay.
Yes.
Okay, cool.
It's
Thank
just
you.
that I can't really realistically explain them to you just yet. We need to take a look at the next slide before they start to make any sense.
Okay,
Oh, don't
sorry.
you worry.
Thank you.
That's right. We're not glossing them over, but we have to save them for a minute. So these are the mysterious terms. All right. So what are these N1 and ND2? All right. So first we have to explain what we mean by D1 and D2. Now these are just these are formulas themselves. Okay. These are actually separate formulas. And so I'm going to show them to you right now. This is the meaning of D1 and this is the meaning of D2. And you'll notice the only thing that was added here that we didn't see in the Black-Scholes model is sigma, which you already know is the standard deviation of the returns to the stock, or as we often call it, the volatility. Now, ln, you'll see, is hiding in here too. ln is the natural log. And if you remember from your math travels, a log has a base. In this case, the log is base E. Okay. Now, this is a very, if you look at your calculator, by the way, you'll notice that most calculators have 2 log buttons written on them. They'll have the natural log, and then they'll also have one with a base of 10, because those are the 2 you're most likely to run into in practice. So, like, you tend to see the log to base 10 in scientific applications. You would have seen it, for example, in high school chemistry or physics. The natural log we see in a lot of applications, but we often run into it in finance. So I'm going to give you a very brief, actually, I just realized my calculator's in the other room. I'll be back in 1 second. I want to give you a very, very short tutorial about logs. Okay, I'll be right back. Okay, here we go. Now, I happen to have this very powerful calculator, the Texas Instruments TI-84. But you know what? It turns out that even your iPhone, if you can believe it, your iPhone actually has a very powerful scientific calculator built right into it. So let me just quickly remind you about the properties of logarithms. We'll start with the simple case, which is log base 10. So we have log 10. If I want to take the log, let's say, of 1,000, you'll see that this is equal to 3 because 10 cubed is 1,000. If I took the log to base 10 of, let's say, 1,000,000, that would bring me back to 6 because 10 to the 6th power is 1,000,000. So when you take a log, what you're really doing is solving for the exponent that you need so that the base raised to that exponent equals the number you're analyzing. Now, if you do the same thing with the natural log, for example, this would simply equal 2. Okay, so just in general, log e to the x equals x. So logs are often applied to powers of x. And in turn, e to the log of x equals x. Okay. So there are other log bases as well, but these are the two you're most likely to run into. For our purposes, because we are dealing with continuously compounded interest rates in this course, for the most part, you'll end up seeing a lot of natural logs. It's not going to be necessary, I guess. There's no real reason why we should ever run across log to base 10, which, by the way, this one is called the natural log. And this one is called the common log. So you'll run into this quite often in financial models. So that's what this ln is doing here. So you get the log of s over x plus r plus a half of sigma squared all times t, all divided by this sigma radical t. That's d1. d2 is just d1 where you subtract off sigma radical t. So that's all built into the spreadsheet. Now, here's the thing though, by themselves, these two numbers don't have any specific interpretation. But if you remember, if you look back here at the formula, you'll notice that we're not solving for D1 or D2, but n of D1 and n of D2. So what are those all about? Well, that n refers to the normal distribution. And by the way, we're looking at a special case of the normal distribution here. I didn't bring this up earlier. Maybe I should have. Hold on one second. Let me sneak this in here. After the discussion about symmetry, I just want to mention that there can be an infinite number of normal distributions, each with a unique value for the mean and the standard deviation. So imagine you're told, for example, that a particular stock that would be one version of the normal distribution. If another stock had a different mean and a different standard deviation, it would be another normal distribution. Now, why did I bring this up now? Because there's one that's particularly important, and that would be this one. There is one special case of the normal distribution of particular interest, the standard distribution. This is the case where, and so the mean is 0 and the standard deviation is 1. This is the version that's being used in the Black-Scholes model. Okay, so Black and Scholes are using the so-called standard normal. Now, as a point of convention, when you're using this standard normal distribution, the values are often referred to as z-scores because we use the letter z to represent the standard normal distribution. Okay, so I'll add that here too. Often represented with the letter Z. Values used in the standard normal distribution are often referred to as Z-scores. Okay, so anyway, with all that being said, the Black-Scholes model is based on the standard normal distribution. All right, so when you calculate D1 and D2, and again, let's go back and visit that model for a second. The ND1 and ND2 then have a very specific interpretation. They tell us let me show you a graph here. Let's say this is the value of D1. We take out our calculator and we discover that D1 has some value, which is right there. And so N of D1 is actually the probability that our normal random variable is less than or equal to D1. So the ND1 and ND2 are probabilities taken from the standard normal distribution. So that's why they use the N for normal. So what they have you do is a two-stage process. You calculate D1 and D2, then you calculate the normal probability of those two, and that's your N1 and ND2. And also, by the way, because they're probabilities, they must have a value somewhere between 0 and 1. Okay, so all probabilities are bounded between 0 and 1. If you get something else, that means you made a mistake. Okay. So we'll see that when we use the Black-Scholes model, by the way. All right, so let's see. Now, oh, by the way, what's interesting here is that the ND1 and ND2 actually do have specific interpretations. For example, ND1 is a measure of how sensitive the option price is to changes in the underlying asset price. So let's say we do the calculations and we discover that ND1 is 0.6. That means if the stock price goes up by $1, then the call price goes up by 60 cents. And that's how we interpret that. And that number is sometimes called, as we'll see next week, the options delta. And then ND2 is the probability that the option finishes in the money. In other words, that it has a positive payoff. So those two can be interpreted in very interesting ways. But the way we calculate them is to use those formulas for D1 and D2, and then we calculate their corresponding standard normal probabilities. All right, so now, with all that being said, we're going to actually do an example. And by the way, this is the example that's in your templates here. So if you look at Black-Scholes example 1, we've conveniently copied the formulas in here so we don't forget them. Here's a situation where we have a 1-year European call option on XYZ stock that pays no dividends, has a strike price of $50. The 1-year risk-free rate of interest is 2%, which means yield on a 1-year treasury bill. The XYZ stock is selling for $52. The volatility of the stock is 30% per year. How do we calculate the price of this European call using the Black-Scholes model. All right, here we go. So here's the results. We have a stock selling for 52. The strike is 50. The risk-free rate is 2%. The volatility, or sigma, is 30%, and it's a 1-year option. So we start by calculating D1 and D2. And if you notice, I've very conveniently typed in the formula for you. You don't want to do all this typing, believe me. The chances of making a typo are extremely high. Look at that formula. Okay, even if you use Excel every day, you might make a typo here. And then you've got D2, which is simple. Once you have D1, you're just taking the D1 and we're just subtracting sigma times the square root of t. Now, here's where it gets interesting. We now need the n's, the normal probabilities. This one is the probability that z is less than or equal to this D1 of 0.3474. This is the probability that z, our standard normal random variable, is less than or equal to D2. So the Excel command for doing this is called norm.s.dist. And if you notice, you need two numbers here, B7, which in this case is our D1, and 1, which is required to show that this is a less than or equal to probability. So we can interpret this as the probability that z, the standard normal random variable, is less than or equal to this 0.3474. This one can be interpreted as the probability that z is less than or equal to 0.0474. And those are my ND1 and ND2. So now, although it's a messy formula, this C here, the call price, is coming from the Black-Scholes formula, which let me show it to you. And again, you'll be happy that it's already been typed for you. Ooh, look at that mess. By the way, I do want to make an important note here. In Excel, if you want to calculate, let's say, e to the minus, let's say 1, you would type exp minus 1. So in other words, the Excel command for e to the x is spelled exp. And then you put in parentheses the exponent. So you can see it right here, exp. The exponent here is minus r times t. And all of this is multiplied by t. So what you have right here is the Black-Scholes price of this call option. Huh. Well, now you might not think that all this math deserved a Nobel Prize, but it sure did. Well, if you could see what's going on behind the scenes, you would realize what a breakthrough this really is. The formula itself is surprisingly simple considering how complicated how hard it is to do this. So that is now, by the way, here's something I would like you to notice. Down here, I've got this little table. What I did was this. I calculated the stock price, the option price when the stock was 52, and I did it again at 53. Now, if you notice, when the stock went up $1, the call price went up by 64.775 cents. Now, why does that matter? Because ND1 is equal to 0.6359. So in other words, the ND1 is the approximate change in the option price due to a $1 change in the stock price. So it's not perfect, but it did a reasonably good job. It predicted an increase of 63.59 cents, and instead it was 64.775 cents. Not bad. Now, even then, the difference between the two is maybe due to rounding errors, but still, you can see it's very, very close. And what's great, watch this. What's great is that, let's say, how did I do that, by the way? Did I start all over again? No. All I have to do is change this 52 to a 53 and write down the new price. And that's how I did this. Now, of course, don't forget to put it back. But you can see the great thing about setting it up this way is that you can just change the S and you can see the impact on the option price immediately. Not only that, but I can change the others too. Like, what if I wanted to know the impact of changing the sigma from 0.3 to 0.4? Ooh, now that you see, it went up quite a bit. And in fact, we'll see that that's going to be very helpful to us next week when we're studying the Greeks, which are a series of risk measures that tell us how sensitive the options price is to changes in these underlying variables. So it's important to know the impact of all of these on the price of the option. As a trader or as a risk manager or a portfolio manager, whatever you happen to be doing, you have to understand all the options in your portfolio, their values can fluctuate very quickly. If any of these variables change, the question is how much might they change? So the options price tends to be more sensitive to some of these than others, but the volatility always has a significant impact on the price of an option. Also, sometimes all we really want to know is whether these changes will cause the price to go up or down. So if I add to the time, for example, let's say to 1.2 years, you notice the price of the option goes up. That's going to be true for the most part. So that's our call price. After all that work, we do have our call price right here and right here. And so we're done. Now, again, the original Black-Scholes model would have stopped right there and said, that's it, you're done. What else do you want? So based on what we saw last week, we can easily go ahead and calculate the put price for a European put that is identical in every way to this European call, meaning it must have the same asset, same maturity, and the same strike price. Otherwise, you're comparing apples with oranges. And if you remember, this is the formula that we used. So this put call parity here is this one right here. Now, there's a messier version of it available, which does not assume that you already know the call price. But as you can see, it's a little bit messier. I went ahead and did some more calculations here in case you're interested in it. And it's in the slides. But the good thing about this is that you do not have to already know the call price to get this put price, but it's a messier formula. So if you do already know the call price, you might as well take advantage of it and use the simple put call parity condition to get your put price. So anyway, here's our results. Now, we discussed this last time. If you notice, though, something interesting, this call is only $2 in the money. If this was an American call and I could exercise it right now, I would only get a payoff of $2. And yet the call price is over $7. What's going on there? Well, let's see, I'm not sure if I discussed it here or not. Yeah, I guess, well, all right, I'll show it to you on a graph. So here's why this is happening. And I think you've seen these graphs before. If you took, we put dollars in the vertical axis and the stock price here, the payoff profile to this call option would be and on the final day of trading, this would also be the market price of the option. But at any time prior to that, T equals 1 means 1 year ahead, you're going to find that the market price is quite well. Let me adjust this a little bit here. Actually, I make it, maybe it's a little too steep. Let me fix that real fast. Yeah, I like that better. So what I wanted you to see is that at $52, intrinsic value or payoff is 2. But the market price is 7,633. So the gap between them is referred to as time value. Okay. The time value refers to the idea that the option could move more deeply into the money within the next year. And so that's what you're paying for. The probability that maybe the price will go from 52 to 55 or 60 by the time the option expires in a year. So here, the time value is actually worth more than the intrinsic value, which is kind of interesting. Now, when the option is out of the money, by the way, if let's say instead we had this scenario, and let's say the stock price is, well, exactly 50. And let's say that, actually, we can actually go check this out right here. Look at this. That means the price is going to be 641. Whoops. So if you notice here, options price equals the time value. Notice the entire value of this option is equal to its own time value, because if you exercise it now, you would end up with a payoff of 0. So the option's intrinsic value is said to be 0. All the value then that market price are entirely paying for the time value in this case. That's interesting. So in other words, the options price is, there's always going to be some positive value. Even remember when we first started looking at option prices on yahoo.finance.com, we noticed some of these, they're worth like a few pennies. All of that is time value because the options are very deeply out of the money. Now, I think I mentioned this too, that over time, though, the time value shrinks. In fact, we can figure it out what would happen in 6 months just by going back to our Black-Scholes model. So we start out with the green line. And at 52, we had a market price of 7,633. But what if nothing changes and 6 months elapse? Let's go back here and change the time to 0.5 or 6 months. The price drops to 565. So you can see we've lost about $2 worth of time value simply because we're getting closer and closer to the maturity date. And let's see what happens. Now, I think that this formula will actually not allow us to put a 0 for t here. No, all right, let's make it something like 0.0001, let's say. And you can see the call price is almost exactly equal to its intrinsic value, which is exactly what we would expect. Okay. Or as close as we can get to it. All right. So that is time value versus market value or an intrinsic value. And it's important to understand how the passage of time actually reduces the time value of the option. And of course, like I said, on the maturity date, the call payoff and the market price are identical to each other. There's no time value left on the maturity date of the option. Now, the put, now you can see we did put calculate the put call parity price, and it's only 464. So for that one, S is 52. So the put is out of the money at this point. So all of this is time value. And just like with the call, as the time passes, the price of the put will shrink too. So in other words, let me reduce this to 0.5. And you can see, yes, it keeps going down. And eventually it'll reach 0 because the put is out of the money. And that means its intrinsic value is 0. So if I put this at a 0.00001 or something like that, you can see the put price drops to essentially 0. Okay. Beautiful. So that is the Black-Scholes, the original Black-Scholes model. And so now what's going to happen is we're going to see what happens when we adjust it, which was done later on. Oh, by the way, yeah, we went over this last time. We showed how arbitrage would result if the put call parity condition is violated. So in other words, if you do see like the Wall Street Journal shows us a price that doesn't seem to be right, or let's say there's an investment bank that's offering their clients a price for an option that's clearly not correct, then you can take advantage of them and put risk-free profits in your pocket by buying whatever is undervalued and selling whatever is overvalued. So we did this last time, if you recall. Again, what we did was we set up two portfolios. The first portfolio has the put and the stock price, or the stock itself, and then the second one has the call and a treasury bill whose value will be guaranteed to be worth X on the maturity date of these options. So the result of that is that no matter what happens to the stock price on the maturity date of this option, the two portfolios will either be worth X dollars or they'll both be worth ST dollars. And that means they'll both be worth the same on the maturity date. And that guarantees that their prices must be equal today. Otherwise, there'd be an arbitrage. You would buy the cheaper portfolio and sell the more expensive one. You have money coming in today and nothing going out in the future. That's why the put call parity condition has to hold. And it is said, by the way, for that reason, the put call parity condition is said to be It's a special name in finance. It's either called arbitrage free or no arbitrage for that reason. Okay, by the way, remember in the slide, I mean, the spreadsheet, I showed you there's a second model there for calculating the put price, which does not require us to already know the call price. What happens is, if you take this relationship and plug it into the Black-Scholes model, in other words, if you replace C with the Black-Scholes model and do a bunch of algebra, you'll end up with this. And so this is the formula that you can use. If you notice, there's no C in there anywhere. So if you want to calculate the put price directly without knowing the call price, you can do it this way. But like I said, it is a bit messier. And so that's why these are here, by the way. Looks like I didn't write the formula anywhere. I might as well write it right now. So it's xe to the negative RT, n of negative D2 minus S n of negative D1. That's what's happening with the second formula here for put prices. We can use put call parity, or we can use this alternative version, which is taken from Black-Scholes. Okay, so that's why these are here, just to speed things up a bit. So you've already got a formula for xe to the minus RT, n of negative D1, and n of negative D2. Okay, and now a lot of this will show up again next week when we're discussing the Greeks. So, you know, it's important to be comfortable with these concepts. Now, as you know, I think I mentioned this before, that Black-Scholes and Merton did not expect this model to be anywhere near as important as it proved to be. As far as they were concerned, it was simply a very interesting research project. And so once it became clear that this was a huge deal, they went back, and Merton in particular started doing more research to see if he can figure out ways of extending the Black-Scholes model to price options on assets other than non-dividend paying stocks. Now, as it turns out, we can use Black-Scholes for any European option, whether it makes cash flows or not. What it can't do is price American options. That's one thing it will never be able to do because of the way it's structured. But at least here, Merton showed us a way that we can price options on, let's say, currencies or bonds or stock indexes or whatever you want to price it on, as long as it's European. So in effect, the Black-Scholes model can price any European options. Now, here's what Merton had to do, though. Let me jump ahead a little bit. We introduced this letter Q. Q is meant to represent the yield of the underlying security to the owner, where Q is defined to be the continuously compounded yield to the owner of the asset. Okay, so I think it's the simplest way to explain this is with currencies. For example, let's say I want to price a European call on the British pound. Now, now we're assuming in this example that if you held British pounds, you wouldn't actually just keep them in your drawer at home. You would have them in a British bank account paying the British pound rate of interest. Okay, it might be your Euro sterling account, or it might be a domestic British pound deposit. It doesn't really matter. We're earning some kind of rate of interest. Now, it turns out that when you have interest, let's say in any bank, really, and particularly in the United States, we know that they compound our interest on a daily basis. So banks compound interest on a daily basis, whether you realize it or not. I mean, or I'll tell you what, where you could find out if you have a credit card, when you get your credit card in the mail, it's got all these legal documents where they're very thick. They're like bulk up the envelope. And somewhere in that envelope, they'll give you some numbers that you should know. Let's say that your card is charging you an interest rate of 18% APR, which translates into, they say, 19.2% on an effective annual rate. What they're basically telling you is that the fact that the rate is being compounded daily is what's responsible for the higher of the two numbers. So the 18% refers to just how much interest you're being charged. But when you compound that on a daily basis, it grows into 19 point, let's say 2%. So you're being told how much you're really paying for this credit card. Now, in practice, banks do not compound continuously. But the difference between daily and continuous compounding is so small that we can basically ignore it. Okay, now of course we shouldn't, but we do because it makes things so much easier. The model is so much cleaner when we have continuous compounding than with daily compounding. Well, we let it slide, let's say. The difference between the two is so trivial that it's hardly worth worrying about. So with the Black-Scholes model, we're assuming continuous compounding. And there are valid mathematical reasons for doing that, by the way. It's not just for convenience, but it's not exactly what we see in practice. But what that implies then is that we can then, for pricing, let's say a British pound call option, we can treat the interest paid on a British pound bank account as a continuously compounded rate of return with very little loss of accuracy. This is designated Q in the Black-Scholes model. So the letter Q means you own this asset. If you own this asset, you will be earning a continuously compounded rate of return equal to Q. Now, unfortunately, the owner of the call option does not earn this continuously compounded rate of return. So that actually reduces the value of the option by Q because you're giving up the opportunity to earn Q when you own the call instead of the actual asset. So if you look very carefully at the modified Black-Scholes model that we're about to look at, you'll see we've introduced this Q here in such a way that it reduces the value of the option. Here it is. In other words, this term was added, e to the QT minus QT rather is less than 1. And so S is e to the minus QT is less than S. And that by that amount, that reduces the value of the call option compared to the original Black-Scholes model. Other than that, now the only other change appears in D1, where we see a Q in there too. So it's a very surprisingly simple adjustment that we need to make to Black-Scholes. Now, all of this, by the way, was done by Robert Merton. Merton is a very well-known researcher. He has his fingers in a lot of different pies, so to speak. He's a very prolific researcher, and he's also made himself rather wealthy as a result because there's some very important credit risk models bearing his name that are based on the Black-Scholes technology. There's one called KMD, which is used very widely in financial institutions to measure credit risk. And the M in that KMV is Merton. And so let's just say he earns a lot of money from that model. And so he's, even though he's an academic, he's also sitting pretty with his finances. So anyway, Merton introduced these extensions to the Black-Scholes model in 1974 paper. That being the case, the extended Black-Scholes that we are now looking at is often referred to as the Merton model. But you can simply think of it as the extended Black-Scholes. It's Black-Scholes with the ability to introduce that letter Q, meaning that we can have assets that have some kind of cash flow. And by the way, we can continue to use this for non-dividend paying stocks by simply setting Q equal to 0. So think of this as a more general version of the Black-Scholes model, introduced by our friend Bob Merton. Okay. So anyway, here's an example. Now, this one is in the second template that I provided you with, Black-Scholes example number 2. And you'll notice for the first time, we have this Q term here that we did not have before. You'll see in the first template, there is no Q in here. Okay, we don't need it. It didn't exist in the original Black-Scholes model. So here we have it. And so here we've got a stock. It sells for $30. The continuously compounded dividend yield is 3%. That's our Q. The risk-free rate is 5%. The volatility. Oh, you know what? I wonder what happened there. The volatility in this example is 0.2. I don't know why it says this. We'll have to change this. Sorry about that. I don't know what happened. I must have made a typo because $30 stock, dividend yield is 3. That's our Q. Risk-free rate is 5%. The Black-Scholes price of a 6-month call option. Now, that means that T is a half of a year, 0.5. And the strike is 28. But it says in the next slide, the volatility is 20%. So I don't know what happened here, but I've just changed it back. And so they're going to ask us to use this new version. And, you know, I've already taken care of that for you, as you can see. And also the newly modified D1 has to be changed as well. That would be up here. I actually did break this up into smaller pieces to make it simpler to calculate it, but everything's the same. And so ultimately we get a call price of just a hair under $3. And again, if you notice, the intrinsic value is only $2. So we have a time value of approximately $1. And the reason why it's lower than in the last example is because there's only 6 months until the maturity date. Okay. Of course, I also, oh, by the way, the put call parity condition has to be adjusted too. Let me skip ahead to that real fast. You see how we've got this extra term here, S e to the minus QT. This is the version of put call parity that we must use when we have some kind of yield to the underlying asset. So the changes are the Black-Scholes or the modified Black-Scholes has this QT in it, as does the put call parity condition. And then there's this Q up here in D1. So those are the changes we have to make to use this new version of Black-Scholes, which, like I said, is often called the Merton model. And then if you can see here, we've also used the Foucault parity condition to come up with the corresponding put price, which is just about 72 cents. Now, also, this alternative version of the put formula has its own change. It now has this extra term that was added as a result of the fact that we do have some kind of a dividend yield. So those are the changes that need to be made when we use the Black-Scholes model in this way. Huh, interesting. All of it is very interesting. So that's our Black-Scholes model. Now, it turns out we're going to need this next week when we're analyzing what are called the Greeks, which are a series of risk measures. Basically, what they are designed to do is tell us, for example, if let's say the risk-free rate goes up, what will be the impact of my option? Or what if the dividend goes down? Or what if the stock price goes up? Whatever the case may be. So we're looking at sensitivities. So those will all ultimately be based on this Black-Scholes framework. So we'll see a lot of these concepts again next week. What we're going to focus, though, our attention on is how these Greeks work and what they tell us and how we can use those to adjust our trading strategies. And we're also going to look at a lot of graphs to try to understand their properties. But it's all going to come from right here. All right, now, let's see, let's go back here. Now here, if you notice, I did include a spreadsheet called the binomial European option pricing model, because now we're ready to take a look at American style options. And that complicates things like crazy. So I'm going to open this thing up. Where is it? Now this you'll see what this printout is all about. It's a much more complicated approach, as you can imagine. Now, you're not going to be required to do this. I don't think you are. Or if you are, you'll be able to use this spreadsheet to do it. Think of it as a template. Hmm. I know, the computer kind of slows down when I'm online like this. I guess being online swallows up a lot of its um, processing speed. What's going on here? So what you're seeing here is anyway, so here's the thing about this. These are the results of pricing an American. Oh, wait a minute. No, this is the European version. That's interesting. Um, I hmm. All right, let me go back to my files here. I think I left something out here. My intention was to give you a copy of the American style as well as the European style. Hmm. Okay, maybe the idea here was to give you this code and then show you how it would be adjusted for the American style options. That is very interesting. Let me look here. By the way, there's a lot of theoretical discussion here. We don't necessarily have to go too deeply into all of this, but we do want to understand the basic functioning of this binomial option pricing model and how it can be extended to price American style options. Huh. I wonder if I put that in. No. Well, anyway, all right, let's just get started here. Now, what we're trying to do here is create a model that would make it possible to price European options, of course, but also American options. And it's a very complex process. This is why Black-Scholes is so popular, by the way, because you know, you're basically throwing a few numbers into a model and you've got a result. This is a very different ball game altogether. You're creating what's called a lattice of potential future prices for your stock to come up with the price of an option. So we're basically going to introduce the basic logic here. So first of all, even though the Black-Scholes model proved to be a huge breakthrough, and it certainly was, it was clear pretty quickly that we'd like to have some methodology for pricing American style options that are consistent with the Black-Scholes framework. Okay. So in other words, the model that we create would have to be such that it matches Black-Scholes prices for European options, but then also provides us with the ability to price American options. And of course, the big difference between the two is the possibility of early exercise. Now, in 1976, only 3 years after Black-Scholes came out, a team of researchers, John Cox, Stephen Ross, and Mark Rubenstein, published a paper in which they introduced the so-called Cox-Ross-Rubenstein model for pricing options. Now, Cox was at Harvard, I think, Ross at Yale, and Rubenstein at Berkeley, maybe. But anyway, they're again, like with Black-Scholes, I don't think they really understood just how important this would turn out to be. What they were really trying to do is try to explain to people exactly what's going on behind the scenes of the Black-Scholes model, because the Black-Scholes paper, if you've ever seen it, is very dense. There's not a whole lot of details in it. That's partially because, you know, these academic journals, they've only got so much space. You know, it's like everyone wants to be in the academic journals, and they've only got so much room. So, you know, they typically, when you publish a paper with them, they're going to take it and shrink it up to the absolute bare bone minimum essentials, with the understanding that, I mean, if you really need more details, you'll probably have to just, you know, get a hold of the authors or something. So the Black-Scholes paper is a little bit light on implementation details. So let's say, in other words, they'll say, yeah, well, here's what we're doing, but if you wanted to turn it into computer code, it wasn't the easiest thing in the world. Well, here comes Cox, Ross, and Rubenstein, where they basically say, listen, here's what they're actually doing with the Black-Scholes model. They're showing you the assumptions that it's following. They're showing you how, well, they're just trying to show you everything in a very simple framework. But then it was discovered that, you know, we can extend this now to price American style options, because you're creating a model where you can look at the option price at different points in time and make decisions as to whether or not you should exercise the option early, which is not possible with Black-Scholes. And then all of a sudden that blew the roof off of trading in American style options, which is important because in this day and age, most options are in fact American style. So this is another huge boost to the options market. And so what did they actually do? They created what's called a lattice. So specifically a binomial lattice. So let me just show you how this works. Maybe I'll start it from scratch. What you're essentially doing is this. You've got a stock, S. And the time, by the way, when you have time indices in financial models, we normally use zero to represent today. One would be 1 year in the future, for example, or at least one time period, whatever that happens to be. So this will be zero. And what they're saying is, listen, why don't we make the following assumption? In 1 year or one period, the stock price can either go up or down, and that's it. There's only two possibilities. And by the way, this is where it gets its name from, the binomial option pricing model. Bi means two. Nomial means numbers, basically, but it basically means that you can only go up or down. That's it. There's no sideways. There's no other options here. And even more importantly, if it goes up or it goes down, the amount by which it can go up or down is fixed over time. So in other words, let's say that I go up, there's a constant U hold on, let me just make some space here. And another constant D, size of a downward movement. Now, this is not a dollar amount, it's a percentage of the original amount. In other words, U could be 1.05, let's say, which means it goes up 5%. And so that means when you go up, you're going to, the new value is U times S. D, for example, could mean going down 5%. And that would be here, we call it DS. Now, in the next time step, here's what would happen. If it goes up again, it moves to the new value, U squared S. Now here, we call this either UDS or DUS because it means the same thing. And then down here, this would mean we've gone down twice. Okay, and then it continues on from there. So in other words, whenever the stock goes up, it rises to U times its current level, current value. When the stock falls, it falls to D times its current value. U and D are constant throughout the lifetime of the option. And if you notice too, now the Cox-Ross-Rubinstein model assumed So from now on, call it CRR model, assumed that going up and then going down, or going down and then going up, returns the stock to its previous level. In other words, U and D are inverses of each other. So in their framework, that implies that DUS and S are the same number. Okay. And so up and down and up means the same thing. It doesn't have to work that way. Now, I just want to mention here, a binomial option pricing model can have many different types of features. Later models did not assume that U and D are inverses and made other assumptions as well. So in other words, there are many different binomial option pricing models to choose from. Oh, Shauna, go ahead.
My question was, or is rather, how would the outcome change if the upward movement percentage increased while the downward movement percentage remained constant? Could that
Well,
happen?
what would happen is the structure of the branches would be different. And so the thing is, this setup was chosen because it's the simplest and it's the most straightforward to implement. I'm sure they realized that down the road, other people would take their model and create more complicated versions of it. So they wanted to start out with the simplest possible case. And also keep in mind too, they are trying to not only price options, American options, as easily as possible, but preserve the assumptions of the Black-Scholes model. So this is the easiest way they could come up with to do that. Okay. In other words, what they're saying here is that what we're doing here is creating what's called the binomial probability distribution, which as we shrink up the time steps converges to the normal distribution. And that's what Black and Scholes are assuming. So they want to not only keep it simple, but they want to keep the same assumptions as Black-Scholes. Now, the later models were relaxing some of these assumptions, mainly because they wanted to be able to price more complicated types of options. We're not going to have time to discuss this just now, but it turns out that, for example, interest rate based options have very bizarre features that cannot really be properly captured with what you're seeing here. They need more flexibility than what we can give it with this Cox-Ross-Rubenstein model. So a lot of the newer models were meant for very specific cases that are more challenging, let's say, than this one, which is basically a simple option, a stock option pricing model. So there's all kinds of ways in which we can relax these assumptions. And many researchers have found other ways. The trade-off, though, is that those are really, in many cases, they're intended for more complicated types of options. And the calculations are much more involved when we do that. This approach is so simple, we can do it in Excel. But if you want something a little different, like you were describing, you would be able to do it, but at the cost of much higher complexity. So you probably reserve it for special cases. For something as simple as a stock option, this is probably as good as any other choice. But anyway, so there's many other options, each with its own set of assumptions. The trade-off between them comes down to accuracy versus complexity. more complex options. Such as, and we'll see, we might have a chance to see this later on. Take a look at interest rate options. Require more complex models than simple stock option models. Okay, because of the properties of interest rates are quite different than stocks. They are much more complicated to price properly, and so it might not be feasible to use this simple framework for, let's say, interest rate options. But anyway, this model is, in the limit at least, as we shrink up the time between the time steps, this model will converge to the Black-Scholes model if it's a European option. If it's an American option, see, here's the beauty of this whole setup. Because if this model faithfully reproduces Black-Scholes prices, then when we extend it to American options, we can count on the results being based on the Black-Scholes assumptions. So that's why this is such a popular approach, because it maintains the integrity of the Black-Scholes model, but still gives it the possibility of pricing American options. Okay. So anyway, this is the basic framework. It's quite straightforward. But now here's the thing, though. This tree only represents stocks. We have to then figure out what to do about the options. So we start with a binomial model for the stock, and whatever results we get in our tree are then used to price the options themselves. Now, how is that done? Now, by the way, there's one thing missing from this tree, which we'll discuss as we go along. The one thing that is missing from this tree, and that's because it needs to be discussed separately, it's such a complicated idea, is the probabilities of moving up and down. We will see that the probabilities used in this model are a special type of probabilities known as risk neutral probabilities, which are not necessarily equal to real world probabilities. Okay. Now that's because option prices are independent of risk preferences, which is obviously not true of stocks. I mean, obviously stocks depend very heavily on how much risk the investors are willing to tolerate. Options do not depend on risk preferences at all. Okay, so that being the case, we can therefore use any probabilities we want in this type of model. Now, we're going to see this as we go along anyway. I might as well mention to you what this actually is all about. In economics, we assume that investors fall into one of three categories. We have those who are risk averse, we have risk neutral, and we have risk seeking. Now, what is this all about? Risk averse investors require a premium to invest in risky assets. For example, risk averse investor would not buy a 30-year corporate bond with a yield of 5% if he can buy a 30-year treasury bond with a yield of 5%. Why should he? Because the treasury bond is risk-free. This is because the treasury bond is risk-free, or, risk-free, I'll put that in quotes. Free of default risk. Okay, in other words, if the government says, listen, we're gonna sell you a treasury bond. You're lending the money, you're lending the government your money. They promise to pay you back a certain amount of interest every year, plus the principal at the maturity date. They know that if they miss a payment, their credit rating will be deteriorated so significantly that it'll cost them a fortune in higher interest payments in the future. So they will do whatever it takes. They'll raise the money from somewhere in order to make sure this never happens. You can't assume the same thing with a corporation because a corporation can go out of business. Okay, the government can't go out of business. So in a case like this, the risk averse investor will not buy the corporate bond unless it offers a higher yield. And that, in proportion to its risk, of course. So like an Apple bond, maybe you can get away with 6%, but a bond issued by a very risky corporation might have to pay you 12%, let's say. Otherwise, nobody will buy it. Now, a risk averse investor, on the other hand, risk neutral investor is indifferent to risk. This investor would buy the 30-year corporate bond with the same yield as the treasury bond. Wow. Now that, you're saying already, well, that can't be right. So that means that this investor will accept any investment that pays the risk-free rate of interest, regardless of the risk. And then we go to the more ridiculous extreme, the risk-seeking investor will actually accept a lower yield from a risky corporate bond than the treasury bond. That's because they enjoy the gamble, basically. I mean, that's what this is all about. Now, in practice, the real world, of course, investors are risk averse, of course. Although not everyone is equally risk averse. Okay, so some people are willing to tolerate some risk and some are willing to tolerate more, but everyone requires compensation to hold risky assets. So in derivatives pricing models, since the price of a derivative security does not depend, and we'll see why later on risk preferences. In other words, we're going to see that the cash flows to a call option can be reproduced with a right mix of other assets. And so the price of the option is really tied directly to these other assets, not to risk preferences. So that means that the assumption of risk neutrality does not affect the price of an option or of any derivative. And it means that all future cash flows can be discounted at the risk-free rate of interest. This makes it unnecessary to estimate risk-adjusted discount factors or rates. So you see, when we price these things, we're actually using the risk-free rate of interest to discount all the cash flows, and that makes things so much simpler. Anyway, as I started to say, when we put together these binomial option pricing trees, we need a stock tree. Oh, and by the way, before I completely forget, one of the implications, assuming risk neutrality, is that the probabilities used in the binomial option pricing tree are not based on real world experience, real world market conditions, but are based on requirement that investors earn the risk-free rate of interest. As a result, these probabilities are known as risk neutral probabilities. Anyway, so you'll see why this matters in a minute. All right, so let's go back to our example of the stock tree. Now, by the way, I'm going to use the letter P to represent the risk neutral probability of moving up. And that means that 1 minus P is the risk neutral probability of moving down. So that's why I'm putting them on there just so you can see them. We don't have to include them because it's understood that they're there. But just this one time, we want to make sure it's clear what's going on here. All right. So what about the stock tree? I mean, the option. Now we need, if we have a stock tree, we need an option tree. Now I do want to mention here, as a side note, we now need a tree to represent the value of the option based on the stock tree. Now, in Hull's book, he's come up with an interesting idea here. He uses the letter R, not R, F, to represent the value of an option, regardless of whether it is a call or a put. Now, the reason why he's doing this is because otherwise C and P could be confused for other variables, especially like P could mean probability, for example. So here's what the corresponding option tree would look like. So at time 0, we have F. And this is what we're trying to solve for, by the way. Now, if we go up or down, we're not going to go up by a constant amount. So the notation is a little different. He's going to use F with a subscript of U. So in other words, this is not U times F. Okay, it's F with a subscript of U. We have to be really careful about that. It could mean anything, depending on the stock prices. So we need subscripts instead of multipliers now. And then if you go up again, 1 minus P, This is what we'll have. Okay. So now here's how we go about this. So we're assuming that this is, just to keep it simple, we're assuming this is a European call option. Okay. We start by calculating the payoffs of this option at time t equals 2, which is the maturity date of the option. All right. So, for example, I wish we could put them all together into one location. It would be a little bit simpler. But here's the stock tree. And here's the option tree. So how do we calculate, for example, FUU? Think of that as the payoff if the stock reaches a U squared S, the top branch. Right, so we reached this point, we went up twice in a row. What's the payoff of the call option at that point? Well, you know that it's normally written as max. But since we reached U squared S, we can rewrite this as U squared S minus 0. Okay. Oh, well, now we're getting somewhere. And that implies that FUD is the payoff if the stock reaches UDS. And that means we have max UDS minus X and 0. And then finally, we have FDD. Payoff if the stock reaches D squared S. And that would be written as max D squared S minus X and 0. Okay, so we can draw this thing one more time. Or actually, no, it's normally written as FU, not UF. Fix that one up. Well, okay, so that's the easy part. What about these nodes? Oh, by the way, these are called nodes. In this terminology, the points at which we have prices are called nodes. So what do we do with FU, for example? So this is how it's going to work. We're going to discount the cash flows. Oh, one more thing. I think I forgot to mention this. The time between each step is designated delta T. Okay, it's a constant. Let's say it's a year or a month, whatever it is. So FU will be calculate in the following way. So in other words, we discount the cash flows from the next two nodes, these two, and now we're going to calculate the expected value of those two nodes, P FUU, P because we're going up to reach FUU, and 1 minus P because we're going down to reach FUD. And then based on the same logic, FUD, FD rather, would be this. So if we go up from that point, we'll be reaching FUD. And now what about this? This is what we're ultimately after, by the way, the price of the option today. Well, based on the same logic, we'll have the discounted value of P times FU, which is where it will go if we go up, and 1 minus P FUD. Sorry, FT. And this is the actual answer to our problem. That is our price. Wow. So that's a lot of calculations, isn't it? It sure is. So once we fill in this tree, now, by the way, we'll see where these numbers, the P's, we're going to show you how to calculate U, D, and P in order to do this. There are formulas for all of them, but I just wanted you to get the basic logic behind what we're doing. Now, if this was a put, the only change is the payoffs on the maturity date. The rest would be the same. So in other words, FUU would be oh, sorry, what did I do? This is U. That would be the only change you would have to make. Wow. So anyway, in this, there's some examples in the slides, but in the spreadsheet, we have, now what I did here was I drew it out by hand. Based on this model here, if we have a 1-year call where the stock price is 100, the strike is 100, it's a 3-period model. The risk-free rate is 6%, and the volatility is 16.5%. So the constants of the problem are U, D, and P. Okay, so the formula for U is easy. Okay, let me show you where we find that in here. I know it's here. I just have to find it. Oh, whoops, sorry. It looks like, all right, let me just copy these. Looks like I copied it wrong. Oops. And then the P is so that's all you need. Now, delta T, like I said before, is the time between steps. So if these are monthly time steps, then delta T would be 1/12 or 0.0833 years. Okay. That's a constant that's given in the problem. So if you have to start by calculating these four values, and then the rest is just this tree approach, which this is, by the way, this is these results are coming from, there's a program in Excel called VBA, Visual Basic for Applications. All of this, these outcomes are coming from the VBA code, which I've embedded in this spreadsheet. It's in here. If you know anything about this stuff, if you look under the developer tab under Visual Basic, this is the code that I wrote for this program. That's where the numbers are coming from. Okay, we're not going to do that here, of course, but this is where these are coming from. Now, but as far as us doing it by hand, you can see that the stock tree is what you see here. 100, and it goes up to 109,99848 down to 90.9134. This one is 3 steps, and you can see we move all the way out to here, and then over here is the option tree. And we can go through and double check these results. And you'll see that ultimately we end up with a price of $10.14 for this call option. Now, the beauty of this thing is that I can change this and come up with different results. Like if I change, let's say, the strike price, I can run it again and see what the new implied option price would be. Anyway, also, if you look down here, you'll see that these numbers have already been calculated for us. Delta T, for example, is a third of a year. Here's P, U, here's D. Disc is just a discount factor. So then, but this is hopefully an illustration of what exactly the model is doing. So anyway, I see it's way past break time. It's about 8:08. Why don't we stop for a bit? Let's come back at 8:30 and I'll just quickly run through what we're actually seeing here and try to make sense out of it and see if we can show how we got these numbers. Okay, so it's exactly what I just showed you, but we'll run through and see if we can calculate some of these numbers and confirm them. And then you'll see that this is the implied price. Okay. All right, then. All right, let's come back at about 8:30 and we'll pick it up from here. So we don't need the Black-Scholes spreadsheets anymore. We're going to focus on this one. And we'll be looking at our trees and trying to see how these option prices came about. All right, I'll see you in a while.
There it is. Ground ball third. Hits the back. Fair ball. One score. That's Rice. And the second is Judge. And it's a 3-1 ball. Yeah. Might have been a double play. Certainly would not have. How good was this memory made out in right field there? And Judge handing the ball to that young fan, and the young fan was overcome. Yeah, just what a great scene. I mean, to me, it's what baseball is all about. Think about it. You know, they built the Judge's Chamber down there. 3-2 pitch from Devin Williams on its way. And he struck him out. 2 out. Is headed home. Struck him out. The Yankees win it. Last season was one for the books. The Dodgers are the World Series champion.
All right, I guess we'll just wrap this up. So I just want to go through this example real fast because in the slides, there's a lot of theoretical discussion about how these results were derived and all, which you can read if you want. And there's other examples as well, but the one we're looking at now is basically the same as all the other ones. So if we understand this one, then we understand all of them basically. Um, so we have our tree, which is coming from these assumptions over here, by the way. So here, U is equal to approximately 1.10. D is equal to 0.91. So if we have a stock price of 100 now, as we go up and down, and the computer, by the way, did all of this, the code that I wrote generated this tree. You can see it goes up to 3 times actually, and then down 3 times. And what's happening is each time I go either up or down, I'm multiplying. If I go up, I'm multiplying the existing price by 1.10. Or if I go down, it's going down by about 0.91. Okay, these are approximate, by the way. So then we've got our entire stock tree. Over here on the right-hand side, we have a tree for a call option. And so the first thing we would do is go to the last time period. Now, since the strike is 100, this part is very straightforward because in this step where we go up 3 times, the payoff would simply be that stock price minus 100, which is 33.08108. Okay, and here again, now that's because here the option finishes in the money, and here's the same thing. Down here, the call option does not finish in the money, so the payoff is simply 0. And then the rest of it is based on this formula I just showed you. So for example, FUU right here, what we're trying to do is take the discounted value using this discount rate, e to the minus r delta t, times the probability moving up to 33.08108, plus the probability moving down to 9.994788. And if you go through the math there, you'll see that that results in a price at this node of $22.06.8. And then you do the same thing here. This is the result of either moving up to 9.994788 or down to 0. This one is 0 because if it goes up, it goes to 0, or if it goes down, it goes to 0 as well. Okay, so we move further back into the tree, and you can see that eventually, at least with these numbers, we ended up with a call price of $9. So that would have been, and of course, every time we run this, we get a slightly different result. But you can see this is how it's done. Now, what about American options? And oh, and by the way, I did mention earlier that if this was a put, the only place where the process would be different would be that you would be calculating the intrinsic value or payoff of a put here rather than a call, but then the rest of the tree would be calculated in exactly the same way. So the tricky part is what to do about American options. Okay, so imagine that you do have an American call here. Let me just copy this somewhere else. Oops, not what I wanted to do. Okay, so this is the option tree. Now, what would be different here? These would be the same. These are all the payoffs. So let's just take this one as an example. Now, we just saw up here above that this is equal to, this is our FUU. The discounted value of P times FUUU, which is this one, and 1 minus P times this one, FUUD. And that's always going to be true. We're always going to calculate that. But if this was an American option, we must consider whether or not it makes sense to exercise it early. But how would we do that? Well, here's what we have to think about. If we exercise early, we will receive the payoff. So at node FUU, the payoff would be, so remember the strike price here is 100. And you'll see the stock price is 109, sorry, 120.9885. Okay, so the payoff we've already seen is 22.06805. Oh, 68. Oh, I'm sorry. Wait a minute. No, sorry. That's not the payoff. Sorry. The payoff would be the max of, now remember, we've reached this node u squared s minus x and 0. Let's see, maybe I can make this font a little bit bigger. And this is meant to be u squared. Let me fix that real fast so it looks right. Okay, now since u squared s equals 120.9885, and the strike price is 100, that implies that the payoff would be a maximum of 120.9885 and minus 100 and 0, which equals 20.9885. Okay, so if I decided to exercise at this node, my payoff would be $20.98.85. If we do not exercise the option early, it will have the same value as a European call option, which we just calculated to be FUU equals 22.06805. Okay. So we know the European value using this approach, 22.06805. If we exercise early, we'll end up with $20.98.85. So the bottom line is, since the payoff is less than the European value, we do not exercise the option at this node. And so we just leave it there. And so then we move on to the next node and we do the same thing. So we go to now for each node prior to the maturity date, we must compare value of the option if it is exercised compared with the value if not exercised. Value of the option at each node is the higher of these two values. So in other words, we're assuming that the option will be exercised at every node where the payoff exceeds the European value of the option. So now what's interesting about that is that if the option is never exercised early, then the European price and the American price will be the same. Otherwise, the American price will be higher. All right, so we unfortunately don't have time to go through a full example from start to finish with the American style options. It would take a long time, but you can see the logic behind what we're doing. And so in this particular case, it looks like, let me just quickly look and see if I find any opportunities to exercise. It doesn't look like it. No, all right. So if you look carefully at all these values on this tree, you'll see that there is not going to be a point where it makes sense to exercise early. So that means this price will apply equally to the American and the European call option. But if there's even one opportunity to exercise early, that means the American price will be slightly higher than, or somewhat higher than the European price. So really now you can see why now. This is why this model, the Cox-Ross-Rubinstein and all the binomial option pricing models can price American options because it is possible to inspect the value of the option at every node. In other words, every point in time, and determine if it should be exercised early. This is not possible with the Black-Scholes model. And the reason for that is because the Black-Scholes model only shows value of the option at maturity. It does not show all the intermediate values. So right there in a nutshell is one of the reasons why the Black-Scholes model can only do European options, because it only shows us what happens on the maturity date. We need something like this to break up the path followed by the option over time to see if there are any opportunities to exercise early. And so that's why a model like this is needed to price American style options. So this did prove to be quite a breakthrough, as a matter of fact. So yes, this is a huge deal. Suddenly it becomes possible to price American style options. And now that blows the roof off of option trading because, like I said before, most options in the market are actually American style. There are certain types that are usually European style. For example, interest rate options are typically European style, but the majority of the options out there are American style. So I have a feeling you'll see one of these days the Nobel Prize Committee will come knocking on the door of Cox, Ross, and Rubinstein, because this really proved to be such a huge deal. Wow, that was an intensive class. But anyway, now the assignment for this week is very straightforward. Basically, all you have to do is a couple of Black-Scholes prices. Oh, no, actually, yeah. Oh, I forgot all about these questions, but these are just there to make sure you understand what we're doing. And then you have two simple problems. You just have to price a European call and put using the Black-Scholes spreadsheets. What you do is you go in there and you type over the existing numbers with these numbers and it'll come back with your price. Okay, so you don't really have to do anything else. Just enter these numbers into this spreadsheet over here where the assumptions are made. Just these, by the way, don't touch these down here. And then you'll have your answer. Okay, so really the challenging part of this assignment is these questions, which test your knowledge of what we just went over. Okay, so I think you won't have any trouble with it. So anyway, I hope, you survived all of that. That was a lot of very complicated material, very theoretical, and there's more in there if you want to read it. There's a discussion in there, for example, about how the risk neutral prices are derived, and a lot of other details, but hopefully you have a basic understanding of how this option pricing model is working. First the Black-Scholes, and then the Cox, Ross, and Rubenstein, and how it's being used to price American style options. All right. So I guess if there's nothing else, I guess we'll stop here. And next week we'll be looking at the Greeks. Like I said, these are risk measures. They were taken directly from the Black-Scholes model, and they're an attempt to help us understand how sensitive an option is to changes in the underlying variables, like the stock price, the risk-free rate of interest, the volatility, et cetera, et cetera. This is very important knowledge for risk management purposes and for trading purposes. Okay, so we'll get to that next time. All right, so I guess I'll see you all next time then. All right, good night, everyone.
Good
Good
night.
night.